Okay, you guys, we're now going to look at exercise 15.9, and here it's the same problem we worked in 15.8, except we're looking at it from the lessor's point of view, and we're looking at it as if the lessor, if the only way they were making profit on the lease was through earning interest revenue. There was no markup on the part of the lessor. Okay, so let's read through it again. On June 30th, 2016, Georgia Atlantic Incorporated leased a warehouse facility from IC Leasing Corporation. And that's who we're going to make entries for here. Actually, they don't ask us to make the entries. They ask for the effect on the balance sheet and on the income statement. But to me, the easiest way to see that effect is just to make the journal entries. And, then you can take a look at those and know which ones are income statement accounts, which ones are balance sheet accounts. It makes it a little easier to see, in my opinion. So I thought I'd handle this one that way as well. You'll see a lot of the numbers are the same as exercise 15.8. It's just now the asset's a little different. Okay, so they said the lease agreement calls for Georgia Atlantic to make semi-annual lease payments of $562,907 over a 3-year lease term, payable each June 30th and December 31st, with the first payment due on June 30th, 2016, the day the lease was drawn. So that makes this again an an annuity due. And Georgia Atlantic's incremental borrowing rate is 10%, the same rate IC used to calculate the lease payment amounts. IC purchased the warehouse from Builders Incorporated at a cost of $3 million. Okay, number one, what amounts related to the lease would IC report in its balance sheet at December 31, 2016? Well, the first step again would be to determine the present value of the lease payments. Okay, and that's going to be equal to the lease payments were $562,907. We're dealing with an annuity due because the first lease payment is made at the beginning of the period. So you go to your table on P-6 on the very back page of the book. We're dealing with 6 interest payment periods because it's 2 interest payment periods per year for 3 years. So that's 6 interest payment periods in the left-hand column, and across to 5% would be the interest rate for 6 months. 10% for a year, 5% for 6 months. So again, our factor from the table, same as in the last exercise, 5.32948. Again, we come up $2 off due to rounding, but approximately $3 million. We're going to go with $3 million. Okay, so in 2016, on June 30th, IC Leasing Corporation would debit lease receivable for $3 million, and they would credit inventory of equipment, or maybe just inventory, it would be credited for $3 million, their cost. So on this direct financing type lease, the lessor, in this case IC Leasing Corporation, they're earning their revenue only through interest. And on this June 30th payment that they received, they did not earn any interest on it, right? No time had passed off. Remember, for interest to build up, time has to pass off. So here, they'll just debit cash for $562,907 and credit lease receivable for the same amount. No interest revenue was earned by IC Corporation, Leasing Corporation, because no time had yet passed off, right? Then we get to December 31st. They're going to again debit cash for $562,907. There also, it doesn't matter, I don't know why I skipped the row there. It doesn't matter which credit you list first, but they're going to credit interest revenue for the original amount of the lease receivable minus the decrease in the lease receivable balance times the interest rate for a half a year, which is 5%. So the original balance in the lease receivable account minus the decrease in the balance of the lease receivable account. So we're multiplying half a year's interest, or 5%, times the balance in the lease receivable account going into December 31st. And that means that IC Leasing Corporation is going to earn interest revenue of $121,855. So the credit, or the reduction in lease receivable, that didn't feel quite right. There we go. Will be equal to the difference in the payment and the interest revenue. So it's going to be $562,907 minus the interest revenue between June 30th and December 31st. So $441,052. Okay, so on requirement 1, they want to know the balance sheet effect. Well, you're going to have an account lease receivable. Its original balance was equal to the $3 million. Okay, and then you had the payment on June 30th. Okay, there was no interest involved there. So we just decreased the balance in the lease receivable account. Remember, assets decrease on the credit side. And then we've got the payment on December 31st, which is going to reduce the lease receivable balance as well. This time, though, I just noticed this. You guys probably noticed it a while back when I made my journal entry. I put the this should have been a credit to lease receivable for $441.52 rather than a debit. Sorry about that. I'm sure you all probably caught it as we went along. Right, we're reducing the balance in the lease receivable account. The journal entry had the balance. Sorry, it should have been on the credit side. Pardon me. Okay. So we're going to say minus the credit to lease receivable here. We get $441,052. I noticed it when it wasn't on the credit side, right? Credits reduce the balance of an asset account. Anyway, I don't know why I didn't catch that earlier. Sorry for that. I could start the video over, but I don't believe I will. I think you guys will be alright. I'm sure you caught it before I did. Alright, so now let's figure out the balance in the account. Lease receivable. December 31, 2016. It's going to be equal to the $3 million minus the $562,907 minus the $441.52. gives us $1,996,041. And that's the balance in lease receivable associated with this lease on December 31, 2016. That's what would show up on the balance sheet. And of course, you guys, that's in the asset section. Okay. Now they want to know what's going to show up on the income statement. Well, remember, no interest was earned on this June 30th payment that was received by IC Leasing Corporation. They only earned interest revenue here on December 31st. So, interest revenue for 2016 associated with this lease would be equal to $21,855. Okay, you guys, that's it for exercise 5.9. We're taking you through the same set of information 3 times. It's a capital lease. So we looked at the entries that would have been made by the lessee. We looked at the entries that would be made by the lessor if they were actually leasing it out to the lessee and only earning interest on the lease, which is essentially a purchase, but only earning interest on it is the direct financing type. The last one we're going to look at in exercise 1510, it's still a capital lease, still the same set of information, but this time the lessor has a markup and they're earning interest. So they have some gross profit and interest revenue to report if it's the next type. Okay, thanks. Please be in touch if you have questions.